Hi there, I'm Alessia Scavuzzo. My name is Caitlin Hartley.
Hi, my name is Emily McIntyre.
Hi, my name is Emily Salter.
My name is Gabriella Wagner.
My name is Sarah Copon.
Hi, I'm Leah Dunton. I'm Kelly Garside.
My name is Orlando Souza.
My name is Matthew Trenier.
I'm Amanda Whidden.
Hi, my name is Carolyn Morgan.
My name is Dushan Lazarevich.
Hi there, my name is Katisha Rashid.
Hello, everybody. My name is Scott.
Hi, I'm Bridget Leonetti.
Hi, everyone. My name is Arash Farahani.
My name is Bhavesh Malwani.
Hi, my name is Blair Smith.
I'm Carol Foderick, principal broker here at the Carol Foderick Real Estate Group. I've been in real estate for 21 years, and it is an incredible honor to lead a team of dynamic, top-selling agents through one of the most fast-paced markets in North America.
Welcome, everybody. Thank you to our Director of Marketing, Dave, for that new intro to the Carol Foderick Real Estate Group Masterclass Seminars. And thank you, everybody who is attending as a participant in this seminar to talk about mortgages tonight on this snowy evening. I know it's a couple of minutes after the hour. We're just going to wait for a couple of more people to sign in as the notifications just went out. And then Jordan Lee is going to get started. So super excited. Jordan, great to see you. Now, full disclosure, you're a little sick under the weather. Is that right, Jordan?
Yes, I am. I'm sorry, guys, but I made it.
You're scratchy. And you know what? It's funny. I was saying this to a client the other day. You can always tell when the spring market has started in the GTA because all the real estate agents lose their voice from talking so much. And I'm sure the same is true for you as well, Jordan.
Yeah, no, this is my second round of sickness this season. So I'm just getting lucky with this.
I love it. That's great. Well, we're going to get started shortly here. And this meeting is being recorded. So just a reminder, if you're watching online currently, you'll be able to unmute yourself, ask some questions. But if you have to step away and you miss any part of the presentation, you're going to be emailed a copy of this recording after the fact. So Jordan, I'm going to let you get ready to share your screen. But while I do, I just wanted to do a quick intro. So to everyone that is joining us live and everyone that is watching this later, my name is Carol Foderick from the Carol Foderick Real Estate Group here at Keller Williams Advantage. And I would like to welcome you this snowy evening to our most recent masterclass in our ongoing series designed to educate and empower you, our clients, past, present, potential clients. Tonight, we're going to be talking about mortgages, how to get one, how to renew one, as well as answering any other questions you might have about the mortgage market currently. I am joined this evening by Jordan Lee, who many of you know already. Jordan is from Jordan Lee Mortgages, and she is one of our preferred lenders here at the Carol Foderick Real Estate Group, has been for a number of years. She's also one of the top mortgage brokers in the country. So it's our great pleasure to have her here to share her knowledge with all of us. And I promise there is a lot of information that we're going to unpack together tonight. We're going to talk about best practices for either negotiating or renegotiating your mortgage. We're going to talk about the questions that you should be asking before you go into either. And of course, we'll be discussing the things that you need to know in today's economic climate to ensure that you're making a good decision with regards to your mortgage, whether it's new or existing. I'm also joined today by my exceptional sales team, the agents that invited you to this seminar. You saw them on our spiffy new intro. As you know, they'll be following up with you in the days ahead just to be sure that you got the information that you needed and to see if there is anything else that we can do to be of service to you. I got asked the other day why we host these masterclasses. Mortgage renewals in particular usually mean that you're staying in your home and you're not moving. So it might seem counterintuitive that your real estate professional is inviting you here tonight to learn more about how perhaps not to move. And it's really just because it's our approach that being part of your trusted advisory circle is based on the fundamental team vision that is our job to provide you with the information and resources that you need to make good fact-based decisions in all aspects of your financial life. Our hope here tonight is that you find the seminar is a reflection of the high level of service, professionalism, integrity that we strive to provide to each and every one of our clients, both before, during, and after we've had the privilege of completing a real estate transaction with you or someone that you know. So on that note, just a couple of housekeeping things as well too. We are going to be recording the call, as I mentioned before, for the benefit of the people who have registered, but were not able to attend live. So please keep your microphones muted to eliminate noise on the call. If you'd like to ask a question or you need clarification on a certain point, you can use the chat function or raise your hand to ask a question. And if you would like to have a question asked anonymously, you can send a private chat message to either Jordan or myself, and we'll do our best to answer it for you. We're going to be sharing this recording with you tomorrow. And as I said, you'll get a follow-up call from the agent that invited you today. But again, just a reminder, we work by referral. If there's ever anything that we can do to be of service to you or someone that you know, it's always our pleasure. So please reach out, whether it's mortgage related, real estate related, whatever we can do to help. And so Jordan, I'm going to turn it over to you. It was a little longer of an intro than I expected. Clearly, I've had a lot of coffee today, but I'm excited. And this is a topic that really lands with a lot of people right now. So let's talk mortgages.
Thank you, Carol. Thank you for the intro. And I'm just as excited. I'm always so grateful to do this presentation for a few years now. And because I find that it's really the kickoff to the year. And in the past few years that we've had, we really do need these market updates. They have not been normal years that we've been seeing over the past few years. So this is always exciting. And I think we finally have a little bit of exciting news and good news to share, where maybe the past few years we were looking at higher interest rates. But I'm going to go over what we saw in 2024 and essentially look forward to 2025, whether you're purchasing or you're coming up for renewal, how that's going to impact you and what we have to think about coming into these new financing solutions in the coming years. So give me a second here to flip over and just share my screen with you. I'm going to jump into the presentation.
Yeah, while you're doing that, Jordan, it was pretty evenly split. We were discussing this as we were coming online, like about half of the registrants interested in talking about first mortgages, and the other half really interested in what's on their horizon for mortgages. So for mortgage renewal. So we're going to talk about all of this. And then you're going to switch over to presenter mode because I'm looking at your wonderful, very well-organized Canva account.
Just showing off my
There we go.
Here we go. Okay, hold on. We should be getting into the full screen now. Give me a second. I think you still see that. Oh, I've lost you now, but you can see my full screen without the Zoom, right?
Yes, we can.
You don't see.
Bit of a lag, I think, Jordan, but that could be Zoom tonight.
Oh no. Okay. Tell me if it keeps happening and I might have to exit and come back in. But if you can see my screen, I'll try to stay on it longer in case. Okay, perfect.
Yeah, I think we're good. Thank you.
Okay. Awesome. So as I mentioned, I want to jump right in because there's so much to cover as we try to tackle for both buyers and people who are homeowners already coming up for renewal. So again, we are going to look at first, starting with, we want to take a look at 2024 first. We want to see what happened in 2024 because 2024 was hugely a transition year in the market. We started to see lowered inflation, and with that, we got to see lowered interest rates. We saw some major government policy updates that we're going to go through as well. And we also, this year and next year, are going to see a huge uptick of mortgage renewals, and we'll talk about why that's important as well. So jumping right in to inflation. I'm not going to talk too long about this. I just want to give everyone an idea of what inflation is around right now. So what you're going to see is in this chart, 2024, and I did this chart from 2019 to 2024. Why I did that range specifically is because I want everyone to see what it looks like, what inflation looks like in a normal year when we're not looking at a pandemic or post-pandemic time. So that would be 2019, right at the top here. So if you can see my cursor, my mouse, this is where we were right before the pandemic, somewhere between 1% to 2%. That is always the goal of where you want inflation to be for a healthy economy. Now, as you see, we went into the pandemic, deflation started, and then we started to see inflation get really aggressive at 8%. So that's when we started to see higher interest rates. Interest rates started to increase with the Bank of Canada to combat this inflation. So with these higher interest rates, we got to see slightly lower inflation month over month until we finally hit our goal in August of 2024, as our goal detailed by the Bank of Canada was to hit or exceed 2% by early or mid 2025. Now, we actually hit that goal at 1.95% August 2024, which seems like it could be good news, right? Our goal is around 2%. We've actually hit it earlier than anticipated. Now, I would focus on that point because I don't know if it's necessarily good news that we hit our inflation goal earlier, because this actually creates a strong point to the fact that it's very likely that the Bank of Canada has actually increased interest rates beyond where it needed to and held the peak interest rates longer than they needed to. So that's what the inflation story is starting to tell us. And I'll talk about that a little bit as well as we look at the interest rates decreasing. So this interest rate decrease is related to the Bank of Canada interest rate. So I'm just noticing there's actually there's an error in this one. Sorry, if you look at January, it says 5.2. That is prime rate. This should read 3% to also be with the target overnight rate. I'm sorry, I'm just noticing this. So this should be 3%. But what I'm trying to show you is the 2024 Bank of Canada interest rate announcements. Now, these interest rate announcements happen every 6 weeks on a Wednesday, so they are pre-scheduled. There do not have to be any changes on these dates. There typically are not any changes on these dates, except for when we're going through these economic times. So they happen every 6 weeks. And the first cut we got to see on interest rates was June 2024, when we finally got to see the first quarter point decrease. And then we got to see consistently, we saw more and more interest rate cuts. Where I want us to focus is October and December of 2024. Why these are important interest rate cuts is because these were not quarter point interest rate cuts. These ones were 50 basis point cuts. These need to be treated as and seen as emergency cuts. The Bank of Canada, as I show you here, does not typically move in more than quarter point increments. So when it is doing more than a quarter point increment, it is signaling that there is an emergency. And this emergency was related to the inflation. Inflation was lower than anticipated, earlier than anticipated, which means we're coming into a weaker economy. Why the Bank of Canada needed to cut interest rates sooner is because it takes a couple quarters for the impact of interest rates to really hit. So they don't have that time to do the slow quarter point increment decreases at this point. They needed to make sure interest rates decreased quicker so that we can see the effect of that quicker as well.
Thanks, Jordan. I think it's such an important part. Sorry to interrupt. I just want to point out, because we talk about, I've often lamented with many of our clients that, in the past, I've been in real estate for, over 20 years. It has only been in the last, I'll say probably 4.5, that we've also had to become like, armchair economists as well too. And so we are, part of our conversation now when we're sitting down to either work with a buyer or a seller is about things like, inflation, bond yields, interest rates, Bank of Canada announcements. And if you're in the real estate space or in the lending space, we now watch the Bank of Canada announcements the way some people watch Super Bowl Sunday. So it's been interesting to see. But to your point, Jordan, as we were in this interest rate increase period earlier in 2022, it took a long time for the effects of those increases to start to be absorbed by the market. And similarly, I think it's reasonable to expect that it's taken some time for those decreases to be felt. And the fact that they're now decreasing as quickly as they are would indicate that there's probably something bigger going on here that they're concerned about.
No, I couldn't agree more. That's exactly what it's signaling. And the fact that we also saw another quarter point decrease in January 29th, so just a couple of weeks ago. I'm going to talk about that more as we look forward to 2025 and where interest rates are anticipated to be headed. But just kind of spoiler alert, they are expected to continue to go down. But we'll talk about the details of that. And Carol, like you said, what I really want to show is, like you mentioned, this is not a normal time. We've been in real estate. You have been in real estate for, like you mentioned, 21 years. I've been doing mortgages for about 10 years, both on the bank side and on the broker side. And yes, we went through other economic crises, but nothing like this before. This is very, very unique. Not only was the pandemic unique, coming out of the pandemic is really unique because of what we're going through politically and economically as well at the same time. So as much as even the real economists, the big bank economists, will try to rely on historics and data to try to guesstimate ultimately what's going to happen, it is a very unpredictable time. It's a very unique time that we're seeing. And that can be really, really represented in this chart alone. And what I'm pointing to here is this is where the first rate cut happened in March of 2020. So this is when the pandemic started. All of these moving up this chart, all of these rate movements happened after 2020. So just in the last 5 years, this whole chart is showing you the movements on prime rate since 2010 over the last 15 years. The majority of them have happened, as you can see, in the last 5 years. That's really, really important to note because, again, it is not normal to have to watch these Bank of Canada interest rate announcements. I know a lot of people are newer buyers. They purchased in the peak of the market around 2020, 2021. So they think this is a normal environment that once you get a mortgage, this is what we have to watch. And this is how competitive the market is or how volatile the market is. No, it is not typically like this. And I do believe that we will start to come into stabilized times, not necessarily in the very near future, but eventually we will get there. This is an economic cycle that we just have to get through. So that's what I want to show you on this interest rate chart. One other thing to note is where interest rates were before the pandemic. Interest rates on the fixed side were between 3 and 4%. Today's average interest rate is in the mid 4% range. We're not that far off from where we were before the pandemic. We can't compare interest rates, unfortunately, to where we were seeing them during the pandemic, which was in that 1 to 2% interest rates variance. We're not going to see that again. I don't believe we're going to see that again. If we ever do, it's a long time from now. Anything is possible, but for the next foreseeable future, I do not see interest rates headed into any kind of space around that. At the very best, if we're lucky, we're going to start to see them start with a 3, but not a 1 or 2.
And it's interesting, Jordan, I think it's a really relevant point to make because there'll be people on this call or watching later that are all primed and ready to go because I'll take a step back. We have seen a huge step back from the first-time buyer pool who would normally be aging through the rental market and buying their first home because they're in an economic position to be able to do so. But we've seen this big kind of step back from the market in the last couple of years, understandably because there's been uncertainty, perhaps about the economy or where interest rates are going to go. But many people waiting until interest rates come down, which I suppose is reasonable, but what I'm hearing is some people saying, I'm going to wait until they get back to where they were. And to be clear, at the toughest part of that COVID market that we were experiencing, because the economy was in such turmoil, we did see interest rates under 2%. But that's also how we got into this economy killer inflation situation that now the Bank of Canada, like many central banks all over the world, are trying to correct. So to be clear, guys, if you're watching this call, either as a first-time buyer or as a renewer of a mortgage, and you're going to watch and wait to see when the bank is offering you another 1.99% interest rate, the chances, I can say pretty definitively, it's probably not going to happen, perhaps in our lifetime, but certainly not anytime in the near future. They're still combating the challenges and the economic volatility that was created from that low interest rate environment. So I wanted to set expectations because you said, spoiler alert, they're coming down. I want to be very clear right out of the gate. If you're sitting and waiting for that to happen, to get under 2%, it's unless we have another black swan event like COVID-19 that disrupts our global economy, it's not likely that we're going to see that environment again.
Yep. No, I couldn't agree more. Those interest rates, unfortunately, in the 1 to 2% range are, I don't think, coming back for a long time, like you said. Now, it's important to also know where we were on interest rates during the pandemic and during the pandemic and post-pandemic, because I want it to be appreciated how much interest rates have also come down. So at the peak of interest rates, when they were at their highest, interest rates were around, on the mortgage interest rates, they were around 6%, if not higher, just a little bit higher at its very, very peak. And then they started to creep down to the mid 5%, and that started to become an average for a few months. Now we're at around 4.5% on average. Yes, we can get a little bit better, maybe a little bit higher depending on the product and the bank, but give or take, it's around 4.5%. So it needs to be appreciated that actually rates have come down about 1.5% to 2% from its peak, from its highest point, which was only about 2 years ago. So rates have really come down. When I say that it's expected for interest rates to continue to come down, I mean nominally at this point. And also, it's not predictable that we know that interest rates are going to be coming down. But even if they do, I mean very, very slightly, not even a full percentage at this point is what is expected. But we will get into that as we look forward to 2025. Now, those are the interest rate updates from 2024. I'm going to jump right into the major government policy updates because this is a big thing that I think a lot of people started to talk about, especially as it got announced last year and it came into effect officially by the end of the year, December 15, which is that we're now getting access to 30-year amortization for your first-time home buyers or your new construction buyers when they're putting less than 20% down. So the change is that previously the maximum amortization period was 25 years. And what an amortization period is, by the way, is it's the length of time that it would take to pay off a mortgage. So what that is dictating is it's ultimately dictating your monthly payment and also your affordability. The longer the amortization, the lower the payment, and the longer the amortization, the more you'll qualify for. 1 second, sorry. 1 moment.
Jordan, I think this is really important because from a real estate perspective, the changes to these policies, and Jordan's having a bit of a coughing fit, which I love because this is it. Like we're the US Postal Service. We just keep going, whether it's rain or snow or COVID or whatever upper respiratory she's got, which I love. But I want to talk for a minute to those of you that are, watching either from an owner perspective or a buyer perspective, because these government policy updates that took effect on December 15th did have a major impact on the market. And it is still taking time for them to filter through. But to be clear, if you are a seller of a property and the value of your property was just in and around $1 million, for a long time, we would be having conversations to say, the buyer pool is substantially higher just under the $1 million mark than it is even at the $1 million mark or over, because of how many buyers in our marketplace are high ratio buyers, so buyers with less than 20%. Now, because the insured mortgage option has been increased to 1.5 million, anybody with a property that was previously valued between like $999 and which isn't somebody trying to be cute, that's just where that ratio took over, and 1.5 million, the pool of buyers for those properties is substantially deeper. And if you're on the buying side of that, it now opens up a whole bunch more housing options in terms of the size of the house, the neighborhoods you can afford in, because you're now able to buy between $1 million and $1.5 million with a high ratio mortgage, which previously was not available to you. And that's relevant in, like the Greater Toronto area, where many of our houses land between $1 million and $1.5 million. So really interesting to see how this is filtering down through the market as well from a seller perspective and a buyer perspective as well too. Are you good, Jordan? We're good?
Yes. Thank you so much for covering that. And
love it.
I'm already seeing it too. We're only a couple of months in of this policy being updated. And I'm definitely seeing a big shift towards, like you said, that $1 million cap where it got busy around there. And now it's that 1.2, 1.3, because that GTA price point, like you're not going to get a lot of properties under $1 million. So that 1.2, 1.3 is becoming a very busy price point. I've definitely noticed that shift already just in the last couple months. Now, why that's really exciting is because one, it's affordability, but two, we know that one big challenge for a lot of home buyers is capital, getting access to the 20% down payment. So let's take a look at the down payment now as well to see exactly how this is being affected. So we've got our minimum down payment requirements. Nothing has changed here except for the maximum for the insured purchase price being 1.5. So anything up to 500,000, you're always calculating 5% of the purchase price, which is always going to be 25,000. Now, when you're looking to put the minimum down payment between 500,000 to 1.5 million, you're doing 5% of the first 500,000 and 10% for the difference. Now, when you're purchasing anything over 1.5 million or more, like Carol said, it's not a number to be fun. It really is. Literally, you can purchase the maximum of 1,499,999. As soon as you hit 1.5 or higher, it is 20% down payment or more required. And this is what it looks like in practice. Just so this is one that I know a lot of people like to take a screenshot of or a picture of. It just breaks down what the minimum down payment is required at every $100,000 increment, starting with $500,000. So very easy to calculate here. And at your top max price point, so let's say you were going right to the top end of the insured, right at that under 1.5, your minimum down payment is essentially 125,000. Okay, so that's the major change. Big update, because for a purchase price of 1.5 normally, as you can see here, you would need $300,000 down payment prior if you're getting to 1.5. So that's cutting the down payment requirement needed by about 50%. That's a huge change. Okay, so
and I think it's important, Jordan. I just want to take a step back because there's going to be people on the call here that are like, well, where is that money coming from? And to be clear, I don't want to minimize the impact of how hard it is to save $100,000 or $75,000 or even $5,000 in any economy. But to be clear, where people, and if you're looking at this last number on the chart and saying, where are first-time buyers getting $300,000 from? The answer is, in most cases, it was being partially funded by gifted funds from family members. And we can get into that a little bit more. But what this change to government policy really did was make that price point between $1 million and $1.5 million, which is where many of the detached and semi-detached and townhome properties in the GTA land, accessible to people who didn't necessarily have large amounts of gifted funds. And again, I'm not saying it's easy to save $125,000, but it certainly is a lot easier than saving 300. And so this was really positive, I think. Now it does still mean it's got to be paid back like it is. It does mean a higher mortgage amount. But in the long run, it has sort of lowered the barrier that a lot of first-time buyers were experiencing into the type of housing that they needed to be able to, buy to suit their family. Whereas before they were kind of pigeonholed into the under $1 million market, which didn't give them a lot of options geographically or from a housing style perspective. So I think it's good news overall.
Yep, I couldn't agree more. And exactly with gifted funds, I'll just touch on that very quickly on what that looks like. If anyone doesn't know what gifted funds are, it essentially is having funds available for the down payment from an immediate family member. So gifted to you from an immediate family member. And the word gift means that it's not a loan. So there's no expectation of repayment. That's the big thing. And when I say immediate family member, that's typically like a sibling, a grandparent, or a parent. Sometimes aunt and uncle can pass as an immediate family member, but typically where the banks really draw the line is no friends. They don't allow friends to give gifted funds towards a purchase. And that's where I would say the line is pretty much
We
drawn.
have a lot of friends that were offering up hundreds of thousands like that. I've never, Jordan, maybe I have the wrong friends. I don't know. If one of my friends is on this call, please, I'm open to donations, guys.
And that's exactly why the bank doesn't accept it, because they don't believe that any friend is giving anyone gifted funds to put towards their home, or else.
So yeah, to be clear here, it's they're trying to root out perhaps abuses of this system or roundabout ways to get through mortgage fraud, because you're right, it would probably be unlikely that a friend would give a friend hundreds of thousands of dollars.
Exactly. But when it's an immediate family member, it's perfectly fine as long as the funds are in Canada. If they're coming from outside of Canada, we need them to be in the country a minimum of 30 days before the closing date. But gifted funds conditions are very easy. Every bank has their own gift letter template. You're just getting that filled out and signed and sending the bank supporting bank statements to show the transfer of funds, essentially. So it is not an issue to have gifted funds on the application from a family member.
And can I ask you, Jordan, so from a lender's perspective or from a broker's perspective, and obviously you've been in the industry long enough to really observe this trend as I have, would you say that the perspective on gifted funds is changing? Because what I'm observing is a lot of concern from, I'll say, like Gen Xers or definitely the boomers about apprehension about how the comment I hear a lot is, how will my kids ever be able to afford a house, or how will young people ever be able to afford a house? And in fact, we know that the average age of the first time buyer is now increasing steadily over year. This year, it's going to be 38 is the age of a first time buyer, which is obviously a huge cry from when, the baby boomers or the silent generation before that bought their first home. Can you comment on the change in attitude that we're seeing from parents towards gifted funds? Because what I'm hearing is people saying, like, I have, huge amount of equity in my house. So perhaps it's not me giving them $200,000, but I'm giving them access to resources that I have so that they can take advantage of getting into the housing market now, as opposed to waiting until I pass and then inheriting a large amount of money that it perhaps won't be needed for housing at a time when their own kids are grown up and gone.
Yeah, no, I'm definitely, I cannot stress enough the level of increase on gifted funds. It is pretty much becoming the standard, especially for a certain age group. I would say around, that would be, I guess, the Gen Z age group particularly, and what's after that? Gen X is after that?
No, Gen X comes before. So Jordan, I'm not going to date myself a little bit here, but I am of the Generation X. Then came millennials. So let's take a step back, because we hear
millennials. There we go.
Quantify them. Silent generation. So people, that were born in the 1930s and the 1920s to the 1930s, who are essentially the parents of the baby boomers. Baby boomers being the generation that was born post Second World War, so like 1945 all the way up to I'm going to get the early edge. I think 1970 is a cutoff for the Generation Xers, the Gen Xers. Gen X is like 70 to 82, and then we've got the millennials that come in around 83, 84, and then Gen Z is following that, and then believe it or not, we've got Gen Alphas. So I've got 2 Gen Alphas at home. So kids that were born in 2014 or later, which is crazy to me. But
yeah,
so there's a little bit, in case you're hearing these terms being thrown around, and we're talking about how the boomers have lots of money. It's the boomers and the Gen Xers that are gifting these funds. And in some cases, the silent generation, that comes before the boomers, who are passing away, leaving huge estates to kids or grandkids, who are then passing it on to a subsequent generation. And it's not to say that these are like the Rockefellers. These are families that just, bought a bungalow in North York in 1952 and never moved, and paid, $22,000 for it. And it's now worth $1.5 million. So the value is only realized when the asset is sold. They weren't sitting on huge amounts of cash, but it's that intergenerational transfer of wealth that's really making a lot of these purchases happen.
Yeah. And so to clarify, it would be Gen Z and millennials then who are getting a lot of gifted down payment. And what I find is, I would actually have to say, just at high level, it is majority of those applications at that age cohort that are getting gifted funds, at least some sort of gifted funds. The amount of gifted funds really greatly ranges. And it can be any amount that can be added. When they are coming from the larger amounts, though, I am finding that a lot of times home equity is being used. And how that's being used is because you can take out a line of credit. A parent can have, and a lot of parents do have lines of credit on their property. So that's another thing to note, is that gifted funds don't have to necessarily come from liquid assets like investments and savings. They can come from a home equity line of credit. So if a parent is sitting on a free and clear home that has a line of credit available, that can be used towards the gifting of funds towards the purchase of a home for their kid. Now, I've seen it. This is not technically, I would say, what the program is used for, but I have seen arrangements where also the kids are getting gifted funds from the parents' line of credit, and they're just paying the line of credit interest cost, so that the parents are not taking on that additional cost. And the kids are, not necessarily that they're going to pay back that full amount, but they will pay the cost of that loan that the parents have taken out. So there's different ways to look at it, but down payment is definitely becoming a lot more leaning on gifted funds than just savings and investments alone, because like you mentioned, looking at this chart, while it is a great advantage to be able to need less capital to get into these price points, it is still a very large sum of money to get to save towards, right? And we need to have closing costs on top of it. So gifted funds are definitely helpful, and we're seeing a lot more of it.
Got it. We really went down a rabbit hole there. I apologize.
Sorry about that. And just to stay on the topic of down payment, one thing that I wanted to mention, this happened a lot earlier in the year, but it is relevant, is that the Home Buyers Plan, which is a government program that allows you to take money out of your RRSPs to purchase your home, a first-time home purchase, which allows you to pay back the amount within a 15-year period. So you do have to replenish your RRSP once you take money out, but they increase that amount per person from $35,000 to $60,000. That one is actually really helpful because a lot of people have had more money than $35,000 in their RSPs that they wanted to access, but they couldn't because of the limitations. So now being able to access $60,000 is very helpful. And that just goes into the down payment. Now, one thing I want to note here is the last point. You must have a written agreement to buy or build a qualifying home to take out your funds from your RRSP. Why I mention that is because of my next note is to, when you're a buyer, something I've noticed a lot recently is to be prepared with your deposit. And what that means is typically, I know, Carol, that this can definitely range depending on the property that the buyer is looking at, but I believe typically it's a minimum of about 5% of the purchase price for a deposit. Now, also just want to check with you, Carol, it's usually when you put in an offer, you need to have the deposit funds within 24 hours of putting in that offer. Is that correct?
Yeah, that's correct. So remember, deposit and down payment, two different things. The last couple of slides talked about down payment. So how much of the total purchase price you're putting down in cash on closing. Deposit is essentially like the earnest money that accompanies the offer or is submitted shortly thereafter the offer is accepted. That essentially binds your agreement. So deposit typically 5% of the purchase price, which will then go to form your larger down payment, but you do need to have it readily accessible. So if you can speak to this, Jordan, because I think that for the first-time buyers on this call, it's something that they're not aware of. If they've got it invested or they're trying to time it when they want to take it out of their market and they want to start shopping for something and they find something that they really like and then realize that they're not in a position to offer on it because it can take, I mean, depending on the product that they've got their deposit money invested in, it can take, and you can speak to this, Jordan, but anywhere between, 3 days and 30 days to get it out of that investment. And that can mean that they lose out on something.
That's exactly it. It's coming up a lot where people are using these registered accounts because they are great programs, but their down payment money or their deposit money is all in registered accounts. So whether it's between a TFSA, an RRSP, an FHSA, so that new first home savings account as well, or invested in the stock market, that's generally what makes up people's savings. They're not usually keeping it in a checkings account. So if that money needs to be accessed for a down payment or a deposit rather, so deposit when you're putting in an offer, you need to be thinking ahead and liquidating those funds ahead of time before you start shopping to make sure that your money is readily available to come up with a draft or a wire, whatever is required for your deposit within a timely manner. Because I have noticed that most banks are quoting between at minimum 3 to 5 business days to start to liquidate those counts and bring them into liquid cash and turn them into liquid cash for you to create that draft. So being prepared with liquid funds for your deposit is very, very important. There are some workarounds that I have been seeing people use, which are using lines of credit, personal lines of credit. Now, when you are using a personal line of credit for a deposit, it is very important to note that what we need to see is that the funds from your savings or investments have been liquidated and pay off those lines of credit. So it's a short-term use to be able to use lines of credit if you need to, because you don't have the deposit funds liquidated, but remembering we will need to show that line of credit being paid back down as zero.
And more to that, Jordan, I think it's important when you're considering this is that it's not just are the funds liquid, but how accessible is the account. So I'll give you an example. We have many clients that bank with I'll say the non-bricks and mortar banks, so like a Tangerine, where it's a regular savings account, and you can withdraw the funds, but in order to actually get a draft out of your account, it can take up to 3 days because there isn't a branch that you can just march into. It needs to be transferred to an institutional bank that you can walk into and pick up your draft. So just be mindful of that, guys. It is a hard and fast 24-hour rule, and if you're late with your deposit, the deal can be canceled. So you want to be sure, like literally to the hour, to the minute, like your deposit needs to be within 24 hours. Unless you're making other provision in the agreement of purchase and sale, but we won't go down that rabbit hole. We can, you should be mindful that you should be prepared with your deposit once you start shopping.
Yeah, so that's just a big point that I've noticed recently, but as we go through those registered accounts, it's definitely that's something that comes up. Now, moving towards the other policy updates, I'm jumping into refinances now and how refinances are impacted. So a couple updated policies that happened on the refinance world is this one is one that I don't think a lot of clients have heard of, and we're not going to take too much time to touch on it, but I do want people to know it is something that is available in case they've heard of it, which is earlier this year, the government is allowing now to have clients who already own their home, so existing homeowners, to refinance their homes up to 90% loan to value of the appraised value if they're taking out that money to be adding an additional home, so like a secondary suite on their existing home. That would be, and it has to be, very particularly has to be a legal additional suite, so legal basement or a legal laneway home. And the money that is being taken out of equity has to all go towards specifically building this additional home. It cannot be used to renovate or pay down debts or anything like that. It all has to be going to directly towards the additional suite. And how the bank knows that you will be putting it all towards the additional suite is by getting plans and permits and all your quotes from contractors up front. The bank will review it and give construction draws essentially and they'll check in to make sure that the construction is being completed and that the money is given as it is due. So they really do check on where these funds are being used and allocated. Now, a couple limitations are, especially for the people in Toronto, you'll notice that the maximum property value limit as improved value, as improved meaning when you add that additional suite. So not before the additional suite, but after the additional suite is added, the property value cannot exceed over $2 million. So that's one big thing that gets in the way of a lot of Toronto properties, because once you add a home, it would probably go over 2 million. And then also a big thing is it being legal. That is a really, really big one because you'll need to get, of course, permits in place to be able to build an additional legal suite. Carol, do you have any comments on this before I move on from this one?
No, just that there's a lot to unpack, and we're talking a lot about just the changes in density that have happened in the city of Toronto in particular, in the GTA as a whole. I mean, most municipalities now are allowing either a dramatic increase in density or a secondary suite, so these auxiliary dwelling units. But in the city of Toronto in particular, most people don't realize it now as a right, every property has the ability to build up to 5 units on their property, which is scary. It's scary for a lot of people, especially if you live in a single family neighborhood, to know that your next door neighbor has the ability to tear down their house and build a 5-unit, essentially apartment building. But to be clear, that is the direction that the city of Toronto has taken. Some people would suggest that this is the most permissive land use for multiplexes anywhere in North America. I don't know that that's been fact checked, but certainly we're not seeing other places that I'm aware of that allow that. And it is really going to change the landscape of what various communities within the city of Toronto look like in the next 10 and 15 years. And you're starting to see them pop up. These are all relatively recent changes. It was only in the last 3 years that garden suites became available, which was the ability to build a secondary house behind your main house, even if you didn't have a laneway. Laneway housing has been a thing here in Toronto for 5 or 6 years, a little bit longer than that in select neighborhoods. But we're now starting to see them being built. You're driving through single family suburban neighborhoods in Toronto, in particular Etobicoke, North York, and Scarborough, where we generally have, large lots, low density housing, and you're starting to see these secondary suites popping up behind. So if you have questions about the ability to build one or more units on your existing house and your existing homeowner, reach out to your agent, because there is a lot to unpack about this. And we are in a rapidly changing landscape. You're going to start to see them popping up, in part because of policies like this. But also with the rental market being strong and demand for housing being high, it is a lot less expensive to build a secondary suite on a property that you already own than to go out and say, buy another investment unit. So if the cost for a new construction condo is averaging somewhere around $1,100 a square foot right now, and you can build on your existing property for somewhere between $400 and $500 a square foot, it makes a lot of sense that to add to, rental units to your portfolio, you would look first towards developing or adding density to either your own primary residence or properties that you already own. But so much to unpack about this. We'll be doing a secondary seminar about auxiliary dwelling units, but just if you're thinking about a refinance at this time, and you're also thinking in the back of your mind, hey, I have been thinking about adding a rental unit, or I have been thinking about a secondary suite for my kids, for my parents, for my own personal use, reach out to your agent, reach out to Jordan to talk about this, because there are opportunities to be able to roll the financing in together. This is just one example of that.
Yeah, no, it's a very big policy update. This one is huge, actually. It'll be very interesting to see how the government kind of updates the policy, as I think that they will, because I do think that this is, for lack of better words, it's a very aggressive policy update. It's a very exciting one, very aggressive one, and it'll be very interesting to see how it is utilized, how much it's utilized over the next year, because these changes to the market, like Carol said, are inevitably happening. Even if you just look around your neighborhood, it is probably popping up where you're seeing a lot of these projects come up now in a lot.
And interesting, just real quick before we move on, Jordan, because there'll be a lot of people that live in these like inner suburbs. So Scarborough is an example. When we talk about the downtown core, where the purchase price is, maybe $1.5 million to start, and then you add a secondary suite to it, and it's well over $2 million. So it excludes you from this policy. But if you look at a place, like Scarborough, where you can buy a detached bungalow on a large lot for still $1 million, add a secondary suite for a few $100,000, you're still well below this $2 million threshold. And so I expect that the exclusion here for properties over $2 million is probably targeted to try to force density in those lower density neighborhoods intentionally. So my thoughts for what they're worth. But let's move on, because lots more to share.
Yes.
Yeah, laneway houses, garden suites, auxiliary dwelling units, so much to unpack. As you have questions about this, just please reach out. I would love to share, specifically with you.
Awesome. And another one about refinances coming up is, this is a big one as well. So essentially the governing body of financing and mortgages, if you guys remember what a stress test is, that was implemented, I believe, in 2018 is the year. And a stress test is essentially us qualifying you at a higher interest rate than what you're actually getting on your mortgage. So let's say, for example, even when the pandemic was around and we saw interest rates at like 1%, 1.25%, even though they were getting 1.25% on their mortgage, we were still qualifying as if the interest rate was 5.25%. That's what the stress test is. It's either going to qualify you at 5.25% as the minimum, or your interest rate plus 2%, whichever is the higher of the two. So while we're in these higher interest rate environments at around 4.5%, that means that we would be qualifying you based off of 6.5%. That's to be conservative, to make sure that if interest rates move like they did over the last 5 years, that you would still be safe and okay to make your payments, because that's what we're qualifying you based off of. That's the stress test, just to keep conservative, pretty much. To keep lending conservative and safe in Canada. That's what the stress test was for. Now, something that's exciting is that in 2024, they announced that we're allowed to now eliminate the stress test when a client is coming up for renewal. So that allows them to start to shop the market in a more even and fair space, because now we're not having to qualify you based off of 2% higher. This is more just about trying to make sure you get the best interest rate. One thing that is major to note here is that this is for, you see here, straight switches only. So I'm going to go over what the difference is between a refinance and renewal and a switch. But essentially a switch means that you're changing nothing about your mortgage. Loan amount's the same, amortization is the same. You're just changing from bank to bank and getting a new interest rate. So that eliminated a lot of people because a lot of people wanted to make more changes to their mortgage, but it's still an exciting rule. Now, the other thing I want to focus on is this last point here. The change, what's expected in by 2026 is up to 70%. It's somewhere estimated between 60 to 70% of Canadian mortgages will be up for renewal by 2026. That is huge. I don't know if people understand the weight of that. That if you look back, it makes a lot of sense because 5 years prior to that was 2020 and 2021. Huge real estate years, but beyond even real estate, speaking from the mortgage side of things, refinances. People were breaking all of their mortgages, anyone in 3%, 4%, 5% interest rates. Everyone wanted to break their mortgage to get into 1% interest rates. I kid you not, I had done multiple refinances at that time where people were paying 6-figure penalties to break their mortgages, 6 figures, like hundreds of thousands, in 100,000 range to break their mortgages to be able to get into lower interest rates at that time. So when I say almost everybody was doing something to their mortgage at that time, I mean almost everybody. And it's clear through these numbers of about up to 70% of mortgages will be up for renewal by 2026. What that looks like in dollar value is 2024, we saw about $251 billion of mortgages come up for renewal. And in 2025, we're expecting that number to go up to $352 billion. So as I mentioned, it's estimated that 60 to 70% of Canadian mortgages will be up for renewal. These are the numbers that total that. That is major, and it is definitely showing. We're already starting to see a huge influx of renewals and refinances coming up. That is, I would say 70% of the calls that I'm on throughout the day is about people coming up for mortgage renewals. Now, I want to go over what the difference is between a renewal, a switch, and a refinance, because they're not actually the same, surprisingly. So a renewal is when you're just switching, you're coming up for renewal with your existing bank and you decide to stay with them. So you're not making any changes, not even with your same bank. You're just choosing a new term and a new interest rate. Why someone would do that is you don't have to requalify. So if you're someone who doesn't want to go through the application process, or maybe your circumstances have changed and you cannot requalify at this time, you switch towards unemployment or self-employment during that time, then you may not want to be going through the requalification process. Maybe your lender is actually the most competitive on interest rates, so you want to just stay there. And then there's no need for new legal work applications and all of that sort of thing. There's no cost to renewal with A banks. So when you're looking at your A primary banks, sometimes when alternative lenders there are, but we don't need to get into that. That's totally different. And then really the main benefit, I think, is that it's for clients who don't want to do applications or switch lenders. They're happy the way they are. They've gotten their lowest interest rate. They're good with it. So that's a renewal, sticking with your existing mortgage lender. Now, if you're switching or transferring, those are pretty synonymous, those two terms. You're just moving your existing mortgage from one lender to another. You're keeping your amortization the same. You're keeping everything about your mortgage the same, except for the rate and the term. So let's say that you have a mortgage coming up with RBC for $500,000 and you have 20-year amortization. Well, then you're going to be looking to Scotiabank, let's say, to switch that $500,000 mortgage, a 20-year amortization, just changing the rate and term. So why that's beneficial is because now you don't have to do the stress test, but you do have to reapply for a mortgage. And why it would benefit is if you're looking for a lower interest rate and we're able to find you one at a different bank, that's your advantage. Now, the main one is a refinance. This is what I'm seeing a lot of people do right now. And the reason being is because refinance, it actually allows you to relook at your goals and your scenario, which the renewal and the switch don't really allow you to do. It's really just allowing you to choose the lowest term. The refinance why I think it's very important to engage with a mortgage broker, specifically a mortgage broker upon your maturity, is because it's a time where you get to relook at all your goals again. It's a time where you get to look at how you can utilize your equity and your mortgage to your advantage, whatever that may mean. It may mean paying down your mortgage quicker. It may mean taking out equity. It may mean adding a line of credit, but it's always important because that's your opportunity to be able to look at your mortgage and see how you can use it best for you. Why I say a broker as well is because at that point, you want to be able to shop all the interest rates again. You don't want just your bank to quote you. You definitely want your bank to quote you your renewal rates. But then when you have those numbers, you want to make sure, am I getting the best across all the other lenders? And that's where a mortgage broker can come in and do that shopping for you. One other thing I want to mention is that you may notice that if you have a mortgage, your early renewal period is actually going to be 6 months prior to your maturity date. The banks do this on purpose because they know that the earliest you can start to lock in a rate is 120 days prior to your closing, which is 4 months. So they try to get you to early renew 2 months ahead of this time. And you'll notice that when it comes up for early renewal, it's never them saying, oh, we're offering you 4.5% and we'll hold this until your renewal date. It's always, we have 4.5% for you, but you've got to decide today or tomorrow because this rate is locked in today and it's going to be gone tomorrow. I can't tell you what's going to happen because they're essentially using like a bully tactic to keep your mortgage in place. They don't want you to have the opportunity to shop your mortgage around. They want to lock you in sooner than later. And that's where I always say, engage with your broker as soon as possible at that 4-month mark, get your early renewal rates. I will always tell you, if your renewal rate is better, stick with them. There's no problem with that, unless we are looking at other goals, because a lot of people right now are looking at taking out lines of credit and taking out equity, especially with everything that's happening around us right now, to have that buffer and cushion, because they don't want to have to qualify later down the road if anything were to happen, knock on wood, but it gives them that extra playroom if you need to take out equity or just add that line of credit for just in case purposes. Now, when you're refinancing, you do have to do a new application. That's the only downside I would say that comes to it. But when you're looking at that as a downside, the upside of doing it is all the other things. You could be coming into future savings. Could be coming into lower payments. We can look at extending your amortization to lower your payments. We could be looking to take out equity. We could be looking at debt consolidation. That's another big one we do in terms of refinances. So refinances really allow all that opportunity to be looked at and reset your goals and how do we use your equity to your advantage. Do you have any comments or questions that I missed out that you wanted to highlight, Carol?
Yeah, I do want to just mention a couple of things. So, Walter and Oski are asking if this presentation is available on a link. Yeah, the slides will be shared with you after, along with the recorded presentation, so you can unpack this. I really want to talk about this. I'm going to use some strong language here because it bothers me whenever I see people being taken advantage of. But there is a predatory nature to the mortgage renewal process that I find is really, really unsavory. And I see it go on all the time. And I know because I get calls from my clients who are at the 5-year mark, or I should say the 4.5-year mark of their mortgages. So we bought 4.5 years ago, and they call me asking for advice like, hey, I'm with whatever, fill in the blank, Scotiabank, CIBC, RBC, they all do it. And my mortgage is coming up for renewal in 6 months, and they're offering me fill in the blank, but they're only giving me until tomorrow. Like, what do you think I should do? I want you guys to know something. First of all, any salesperson, and essentially that's what the mortgage renewal people are. They're salespeople. They're trying to sell you a bank price, resell you the bank product that you signed up for last time. And it may not be under favorable terms or the most favorable terms that are accessible to you. And so it really bothers me because I see scare tactics being used. I see people being like, oh, you have to sign today. The promotion's only on until later today. They're trying to destabilize you so that you don't feel like you have time to explore other options. And it's important that you know that even if you have a great relationship with your lender, and even if you intend to keep your lending products with them for whatever reason, there is always still an opportunity to maneuver a better rate. And I'll be clear, I have full transparency. I have a lot of bank accounts with CIBC. I tend to group a lot of my financial products there. I had one of my investment properties came up, my CIBC mortgage came up, and they offered me a rate which was okay, but not great. I reached out to Jordan. Jordan was able to get me qualified at a lower rate through another bank. And although I chose to keep my mortgage with CIBC because I didn't want to go through the refinancing process, I was able to leverage the approval from the other lender into a substantially better rate, much better than anything that they were initially offering me. So I really just want to highlight, guys, like when you get those calls, and they will be very compelling salespeople, this is the value of your mortgage is worth tens or sometimes hundreds of thousands of dollars to the bank. They are going to try to hold on to you with a chokehold. Please don't feel pressured. You have the time to think rationally about it. You have the time to sleep on it. You have the time to get a second opinion from another trusted source. Please, 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 even if you intend to renew with them, take the time to do some due diligence, because even a 0.1% difference in terms of what they're offering you translates into tens of thousands of dollars over the lifetime of your mortgage. It's really important. So I just wanted to share that, guys. Please, there is especially in this climate with all of these mortgage renewals coming up, the banks are fighting each other tooth over nail for this mortgage business. Please, guys, reach out to me, reach out to Jordan, reach out to a broker that you know to get a second opinion. What they're offering you is almost certainly not their best offer. And it's important that you know that. So sorry, that's my rant for today, Jordan. It bothers me because I get these calls from people who feel like they're up against the wall, and it's an artificial urgency that has been created as a scare tactic to try to get you to sign as quickly as possible without looking at other options.
Exactly. And it's also so unrealistic that, from today to tomorrow to the next day, interest rates are going to change. So it really is a bully tactic for them to say, no, you've got till tomorrow. They don't want you to have the opportunity. That's what it's all about, to talk to anybody else. It's not about the fact that interest rates are likely to actually move. It has everything to do with that. They know that they need to shorten your timeline and bully you into locking in ASAP. And another thing I'll say too is, like, when I'm going through that conversation with the client that's coming up for renewal, I always say straight up, tell your existing lender that you've engaged your broker. So you need best and final. Tell them you're already halfway out. I need to know what your very best interest rate is, because it is very frustrating that there is that game of, oh, okay, so it starts at 4.5 and then turns out they can do 4.4. Oh, and then they can do 4.3. Well, which one is it? Tell me right now, why do we have to play this game of back and forth, back and forth? What is your very best? What can you do for me? If not, it's only fair that you have the opportunity to start to shop around and see if there's something better for you, right? It's your mortgage, it's your money. They should not be policing that by any means. So
there's a question, Jordan, and I think you'll probably address it. Do mortgage brokers take a fee for shopping the rates?
No, we don't.
They do not.
We don't. And I won't generalize that statement. Some mortgage brokers unfortunately do charge fees. I am not one of them. I don't think it makes any sense. I will be completely transparent that the banks pay us directly when we are doing mortgage transactions. That is how we get paid, directly from the bank. There is no reason for us to charge clients fees on top of that. Some brokers choose to. I don't think it makes sense to. The only time we need to charge fees in terms of need to is alternative lending, but I don't think we're talking about that particularly here.
No, I think that's important. And to be clear, just to clear the air, there was previously, I think, some misunderstanding years ago that you went to a mortgage broker only if you had trouble getting lending from like an A lender, and you'd go to a mortgage broker to secure secondary funding from a B lender, or from a, because you were difficult to qualify. To be clear, that is not the case. In fact, the most my triple A credit, triple A income clients are all using brokers and are more have more loyalty to their broker than they do to a particular lender, because they use a broker to shop rates over different lenders.
And I'll tell you why. It just happens to be the next slide.
Oh, there you go. Okay.
Why people tend to call their broker over their banker, honestly. And it doesn't have to be me. Any broker that you are connected to and feel comfortable with, and I'd be grateful to be that person, but any broker. And because I'll tell you that I myself left the banker channel to go to the broker side for all these reasons. Even not even on the client side, but as a broker, as a banker, it made no sense for me to stay at the bank. Why would I try to sell? And what it is it is selling at that point, because I only had one product to offer clients, no matter what they told me by the end of that call. Now, as a broker, I actually am able to look at customizable solutions, listen to what they're telling me, and figure out what is the best product, who is the best lender for them based on what they're telling me. Also, exactly like you said, letting us do the rate shopping for you. It makes no sense. The reason the AAA clients choose brokers is because they know they're going to get qualified at a bank. They don't need to go into a bank to find that out. They know. So what they're looking for is, okay, well, who's going to give me the best offer? Because I know I'm that A+ client, AAA client. Who's going to give me the best offer? So let us do all that work for you instead of you going bank to bank to bank. The no cost to work with us is, again, when I generalize, some brokers are a little bit different, but I will tell you up front that it shouldn't be that way. There is no necessary reason for why a fee should be charged with any kind of a lending, simple application process. And why I highlight ongoing consultation is actually related to the refinance message. What happened recently is that I started to do a campaign for two things. When the insured rules was coming out to be changed, I reached out to all the way starting in November, all the way through to January after the policy change came out. For any people who did an insured pre-approval with me previously, I reached out to everyone to make sure, do you guys know about this policy change? Let's get you reassessed. If you're already an insured pre-approval, let's see how this 30-year amortization or this 1.5 purchase price now impacts you. It impacted a lot of people. And a bigger one is the refinance one that we recently did. A lot of my clients, unfortunately, were locked into 6% interest rates because that's where interest rates were at the time, just a couple years ago, a year and a half ago. We were able to reach out to those clients to see, does it make sense to refinance and break your mortgage, even with a penalty, to see if it makes sense to get into lower interest rates today sooner than later, and do a whole refinance analysis for them, even including their penalty, what's the savings, what's the cost. And that has created huge tens of thousands worths of savings for clients. So why this is a huge thing to mention is I guarantee you the banks are not doing that. And why the banks are not doing that? It's because they don't have the option to. Where are they going to refinance you to, right? Everything is internal. And also turnover, high turnover. We know that happens. People enter and leave the bank all the time. So if you do want that long lasting relationship, I do think working with a broker does make more sense. And that's my final plug. That's all I have.
I will just say this. So two things I'll add to that, Jordan, and then we can move on, is when we're working on the purchase side and you're a first-time buyer, and the challenge is that a lot of real estate is transacted in the evenings or on the weekends. That's when you're shopping for real estate. That's when you're offering on real estate. The challenge for us from the real estate side is that if we need information from your mortgage broker or from your lender, and you are working directly through a bank, and the bank closed at 4 o'clock and offers are at 7 o'clock, and we need just clarification on one point, or for us to unpack something with their lender, and literally there is nobody to call, there are no answers to be had. And so that's really, really challenging for us. And so that's why we find that the mortgage brokers who are, independent contractors have more of an entrepreneurial spirit and will take calls in the evening. And I'll apologize in advance, Jordan, because sometimes we're calling at 10 o'clock midnight in the middle of the offer. Hey, can we structure the financing like this? Is this going to be okay? And we can get that definitive answer that allows you to move on something. And the other thing that you mentioned, Gabriella made a great point here, Gabriella Wagner. At the end of the day, the bank works for the bank, a mortgage broker works for you. This is important because you mentioned your compensation model. And it is important that we're transparent about that. Very much in the same way that real estate agents are compensated by the listing agent for the property that you buy, we owe our clients a fiduciary responsibility to work to get them the best deal possible. Jordan and brokers like her are acting very much the same way. Although they are being compensated by the bank, they have a legal responsibility to give you 3 options, if I understand that correctly, where 3 options exist, and also to advocate and represent your best interests. And they're legally obligated to do that. So despite the fact that they're being compensated by the lender, they are working for you, even though you're not paying them directly.
No, exactly. And I
I
would
saw the next slide. I'm really excited about this one, Jordan. Where's the economy going? Can't wait to talk about this some more because we've talked a lot about interest rates, Bank of Canada, inflation, bond yields. The question has been tariffs. And we're not going to go down this rabbit hole because we could have a whole seminar just on this. But there is a lot of speculation about like how the changes in the economy that could happen over the next little bit, how that is going to impact the future of interest rates. And I think there's a lot of people on this call here tonight and watching later that are going to be very curious about this.
Yeah, I think that ultimately I know that whether you're a buyer or coming up for renewal, this is what you're looking to hear right now. And just jumping right into it, where is the economy headed? Where are rates headed? The answer is an unfortunate, I don't know exactly. And I'm going to skip back. Sorry, I just skipped ahead one, but this is lagging. Sorry about that. But we're going back to here. So where's the economy and rates headed? Why I put this slide here is because, of course, you can see the headlines. We've all seen these headlines for the past couple months at this point. It's nothing new to us. But why I really want to stress this, everything that's going on, is because it's very unpredictable. You can ask the big bank economists, you can ask the Bank of Canada governor, you can ask the president, you can ask the prime minister. They don't know. Because ultimately what's happening right now more than ever is it's a very reactionary market. And I mean very. And how I can stress that is in this next slide. So this is showing you guys, so the Bank of Canada policy rate is at 3% today. The Bank of Canada policy rate is what we're watching when we do those every 6 weeks Bank of Canada interest rate announcements, right? So that's what we're watching for. It directly impacts prime rate. You see, I have 3 of the same chart here. So if we look here, top left, this is what it looked like prior to the tariff weekend. And sorry, to clarify what we're looking at, is this is the markets betting on whether we're going to see interest rates decrease or stay the same on each of the next interest rate announcements. So you can see that the interest rate announcements detailed here, the likelihood of the interest rate staying or moving, and what the percentage is. So I'm just going to focus even on the next one. So prior to the tariff weekend that just happened last weekend, we
Tariff
saw
weekend, is that a thing? Is it now like this is like tariff weekend? Okay.
that's what I'm referring to it
But it
too.
was, if you watched it live on television, that was like the press conferences and the announcements and the counter announcements. It's like, you can't script this stuff, guys. It's like we are watching history unfold in front of ourselves. And it's just, it was, okay, so tariff weekend is what we're calling it.
Tariff weekend. Yep, that's what we're calling it. I'm sure it's going to go down in the history books that way. But tariff weekend, we saw, so next interest rate announcement. So we know that the Bank of Canada interest rate right now is at 3%. So for the next interest rate announcement on March 12th, they were assuming that there was a 59% chance it would stay at 3%, a 41% chance that it would go down to 2.75. It's a pretty weak estimate, in my opinion. That's pretty much like saying 50-50. Now, we go post tariff weekend. So then he goes, okay, yes, we're implementing the tariffs. It's going to happen. We're looking to move ahead on this, right? We all remember that happening on that Monday and Tuesday. So then what happens? Well, now on that same estimate for the March 12th announcement after the tariff weekend, now there's only a 18% chance it stays at 3% and an 82% chance that it would decrease to 2.75. It's a really big change week over week. And then he says, okay, no, we're gonna hold off for 30 days on these tariffs. And then what happens to the market? Goes back to pretty much 50-50. Now we're back to at 3%. It's a 61% chance we'll stay at 3%. And now it's a 39% chance we're gonna go down to 2.75. Why I show you guys this is not so much about the prediction itself and everything to do with how reactionary it is based on just the words that come out of the US office's mouth, right? And because the words that come out of his mouth or the US office's mouth are going to change the trajectory of the economy depending on what gets put in place. And the tariffs play a huge part that we know, obviously we're all watching the news, we know is far from gone and over. We have settled it for maybe 30 days, but now a couple days ago, we're looking at 25% tariffs on steel and aluminum. So that's going to shift the economy. And how that's going to shift the economy, by the way, is we're going to see lower productivity on businesses, which will ultimately mean higher unemployment. The estimation of how that will impact unemployment, it really varies because, again, everyone is just trying to guess based on what is being said at this point. but it looks like it's going to be in the hundreds of thousands of unemployment jobs that will be lost if the tariffs do come into effect the way that they are anticipated. Now, what's tricky about that from an interest rate perspective is that that means we would be going into a weaker Canadian economy, right? Less spending is going to be happening. So yes, we'll come into a weaker Canadian economy, which means that lower interest rates would need to happen. But what's also going to happen, what's very unique about this is what's also going to happen if these tariffs come into play is inflation, right? And you can't tackle both things at once. So that is where it is very difficult to say, and the Bank of Canada governor said it himself on the last interest rate announcement, they're just going to have to assess and watch because they cannot do both things at once. You cannot tackle a weak Canadian economy and inflation with interest rates at the same time. We do believe that interest rates are likely to continue to go down, as you can even see per these charts. It is likely that we're going to see at least another 50 basis point decrease on prime rate. I'm going to flip into the next slide as well to show you what the big banks think as well. The big banks, these estimates do change, by the way. So as data comes out and statistics change, these numbers will get updated, but this is a general idea of what the big bank economists are predicting for the Bank of Canada policy rate. Now, again, it's always great to look at what they're predicting. Interest rate is at 3% today. I want to remind you guys that this is not mortgage interest rate. This is Bank of Canada policy rate, which is related to prime rate, which is prime rate is the variable component of a variable term mortgage. So I just want to clarify that for you guys. So today it's at 3%. It's great to see what they predict it to be per quarter, but ultimately what I really want to show you guys is the variance between the projections between bank to bank, because that to me tells me that everyone is just giving their best guess based on data that's available and historics that we can lean on. But ultimately, there's a 1% variance between the highest estimate and the lowest estimate. So the big banks don't know. Just as much as we don't know, the big banks don't know which way this is headed, because again, it's going to be very reactionary. And Carol, do you want to talk about anything before I head into the question?
Yeah,
about
I know you're getting
variable?
ready to wrap up your thing because I want to leave enough time for some questions. And again, I promised you a lot of information to unpack. So it's, and definitely it has been. I want to be clear here, guys, like for many of us on this call, realtors included, you're not going to be absorbing or understanding 100% of what you hear. So if you've heard terminology, that you're not familiar with or you're not fully understanding, please know that that is completely to be expected. We do this at a very high level to be able to show up in service to our clients. But to be clear, the way that everything we're talking about tonight impacts you and your situation specifically is you need to have the opportunity to sit down with somebody who is as knowledgeable as Jordan or another broker that you trust and unpack what all of this means to you specifically for your payment, your mortgage, your rate, your decisions. And I really just want to underscore that because we're talking about a lot of big economic, terms. But so if you're feeling a little bit in the weeds here, guys, please know you're not alone and somebody will sit with you and take it, from where you're at. The one thing I just want to highlight here, Jordan, you mentioned it a little bit, that the Bank of Canada rate is not the interest rate that is being offered to buyers. And this is really important because I hear from a lot of our seller clients, well, interest rates are coming down. They're going to make another policy announcement in a couple of weeks. So more buyers are going to re-enter the marketplace. I'd love for you to talk about the differences between fixed and variable as they relate to these Bank of Canada announcements, because there's going to be first-time buyers on this call or sellers on this call that are listening and saying, well, the market will move faster or mortgages will be cheaper when the Bank of Canada makes these Q4 rate cuts. So I'm going to wait another year to buy something or to list because the market will be different when interest rates are 0.75% less than what they're at now. That's not the case.
Mm-hmm. Yeah, no. A few things to point out there is that when people are reading about this on the news, they do refer to the policy rate. So I do even hear clients say like, oh, no, rates are projected to go down to 2.5%. Like that is how they are reading it, because that's what the news is reading in the headline, right? Bank of Canada policy rate, interest rates, this, but they're talking about this rate, which is not mortgage interest rates, but I do hear it referred to as mortgage interest rates. So that is one huge clarification to make. Those rates are not the same. Now between fixed and variable, Your variable rates are what are related to this Bank of Canada policy rate, because this Bank of Canada policy rate is directly related to prime rate, which is the variable component of a variable term mortgage. So what I mean by that is your variable term mortgage is going to be made up of prime minus a discount. So prime being the fluctuating number, and it's starting today at 5.20%. That's prime today. And the bank will offer you a discount. That's your fixed component of a variable term mortgage. So it'll be prime minus, let's say, 0.5 as an example. So today that would be 4.7. And that interest rate now is your mortgage interest rate made up of prime minus a discount, all related to the Bank of Canada interest rate announcement. If Bank of Canada's interest rate announcement goes down a quarter point, so does prime rate, and so would your interest rate. So that's how the variable rate is impacted by the Bank of Canada interest rate. Now, fixed rates are priced completely separately. This is another huge clarification to make, because I hear this a lot as well, that a lot of people think that fixed rates are going to decrease with all of these Bank of Canada interest rate announcements, and they do not. No relation at all. Fixed rates are primarily based off of bond yields and the cost of funds from the bank. So cost of funds from the bank, just to break that down, just means essentially what they can afford to make their interest rates based on their deposits and other factors, essentially. So fixed rates are priced completely separately from variable rate mortgages. And now variable rates as of right now, by the way, and I'll go into this a little bit more as we go through fixed versus variable. Actually, you know what? Let me do that. So let me go into fixed versus variable. So the interest rates themselves right now, if you're looking at getting a mortgage, are not that different between a fixed and a variable. Like I said, your average is going to be around 4.5%. That's whether it's a fixed or a variable, give or take. If it's an insured mortgage with less than 20% down, you are typically getting lower interest rates. And I'll mention why that is as well. A lot of people always ask me, why do insured mortgages get lower interest rates? And that's because it's lower risk to the bank. When you're getting an insured mortgage, it comes with a default insurance premium that's added to your mortgage, and that's in protection of the bank. And that is why the bank can offer slightly lower interest rates on insured mortgages. So anyway, all to say that between the fixed and the variable, the actual interest rate itself is not going to be that different. So that's not going to be what sways you from one to another. What's going to sway you from one to another is the actual logic and decision-making process and risk assessment associated to it. Now, when you're looking at fixed rates right now, the benefit you're going to get, an advantage you're going to get, is essentially stability and predictability. You know what your interest rate is, you know what your payment is. You do not have to worry about what's happening in the world around you. You don't have to worry about how that's going to impact you or your payments. You know what you're focused on, you make your payment, and you're good to go. The worst of a fixed rate is you are likely to see interest rates go a little bit lower than what you locked into. That's the very worst of it. This like feeling of this FOMO, that fear of missing out, you'll probably see interest rates lower a little bit less than what you have. Now, I really don't think that's the worst case, because here in Canada, we have very short-term mortgages. We're pretty much, when we're looking at fixed rates, we're pretty much looking between 3 and 5 year fix. So even though, yes, interest rates will probably dip lower than what you locked into, sooner than later, you're going to be able to renegotiate and renew or refinance at that timeline. Now, on the variable, very different advantages. The variable advantage right now is all about flexibility and control over your product. So the flexibility main feature is that you are able to lock into a fixed term at any time with no penalty from your variable to a fixed. I believe that that alleviates a lot of the risk associated to the variable, because if your concern is that interest rates go up and what if things start to move in that direction, well, you can always jump ship and lock into fixed rates at the time of. And that's something I want to clarify, is from a variable to a fixed, you're not locking into where your variable rate and your variable interest rate is. You're locking into where fixed rates are at the time of. So that's one flexibility. The second is the fact that we do anticipate that the Bank of Canada will continue to cut interest rates. So if you do believe that as well, you want to capture that as it happens, and you want to be able to see your interest rate lower as this Bank of Canada interest rate continues to lower. So you're capturing the rate cuts as they happen. And the last is the prepayment penalty. The variable will allow you the lowest prepayment penalty, which is 3 months interest. So easy to calculate, and typically the lower of the two penalties. Fixed rate mortgages penalties are based off of interest rate differential. And what that essentially means is they're just going to take the difference between your interest rate on your mortgage and the interest rate at the time of you paying off your mortgage. They're going to take that spread for the length of time remaining on your term and make you pay that up front. That is typically the higher of the two penalties. Interest rate differential on fixed terms is the higher penalty. Now, one thing I say about the variable as well is, from a logistic perspective, it does seem to make sense to take a variable with all the flexibility features. But what I do say to that is that we are, again, in a very unique time. And I can almost guarantee you that the next 2 years of news is going to be a lot in terms of economic news, political news. It's going to be a lot. We're not going to be able to avoid it. It's going to be all over the news, social media, dinner with friends, at the office, wherever you go, people are going to be talking about it. And if that's something you're a generally very anxious person, you may lean towards a fixed over a variable. But again, being able to lock into a fixed from a variable at any time with no penalty really does alleviate a lot of that risk. So that is where I stand between the fixed and variable. I also will say that I get a lot of questions about what would you recommend? What would you do? And I don't have a general answer to that, unfortunately. It really depends on your goals and your personality. I will always do all the legwork to make sure you are comfortable with the decision you're making, whether that's going through payments, going through the different risk scenarios of the term you're choosing. But ultimately, I want the client to feel comfortable with the decision they're choosing between a fixed and variable. There is no wrong option. I will say that as well. It is what the clients, in terms of their risk assessment and personality right now, particularly, that matters the most while we're choosing the term. And also to speak on that is, we were talking about this earlier. This is not a normal climate at all. If you asked 5 years ago, people were just choosing between a 5-year fix and a 5-year variable. It was that simple. We weren't looking at these like 1-year fix, 2-year fix, 3-year fix, 4-year. They really didn't come into play. No one really needed to think about that. It was as simple as choosing a 5-year fix and a 5-year variable. The only reason these short terms, these shorter fixed terms like 2 and 3 year are starting to come up into conversation is because people are wanting the opportunity to be able to renew sooner than later in case interest rates do lower. So they don't want to hold on to the higher interest rates for longer than they need to. So that is why there's the introduction of all these new terms, where typically in Canada, we're choosing between a 5-year fix and a 5-year variable. Funnily enough, I've only ever sold one 10-year mortgage in my life, and it was to an American, because Americans are used to 25 or 30-year mortgages. And it's just funny because it didn't make sense to me at the time, but that one client is now locked into a 1.5% mortgage for 10 years. He knew something that we all didn't, apparently. It's just incredible. But that is pretty much your fixed versus variable. I think, if I'm not mistaken, I think that is my last and into questions. Yes, it is.
I have some questions for you, Jordan. My goodness. And it's interesting because we had some pre-submitted questions, and of the 100 or so questions that we got ahead of time, the vast majority of them were like, what's happening with interest rates? So your presentation has made it clear that there's a lack of clarity around what's going to happen in interest rates, except to say that we expect them to continue to, the Bank of Canada rate to continue to decline. It may or may not have an impact on fixed rates. It will have an impact on variable. But all of this to say, if you've got a mortgage coming up for renewal, you really need to sit with a qualified expert to unpack your circumstance specifically. And if you're watching this as a first-time buyer and you are thinking about getting into the market, the same holds true for you. You need to sit down with somebody and unpack your circumstance. I do have some specific questions that were shared, and if anybody wants to pop anything into the webinar chat, you certainly can. A couple of questions. So if I already have a variable rate mortgage, should I stick with it? And again, let's qualify this to say that we're not giving out mortgage advice here that is specific to people's circumstances. These are general answers to general questions, but let's put yourself in the situation that actually I know you and I are both in, Jordan, because we talk about this often. You and I both have at least one variable rate mortgage, and we rode the roller coaster up.
Yeah.
How far down are we riding it? That's the question.
All the way.
And I'll ask for this participant and also myself. All the way? All right.
All the way down. Well, I didn't
Die,
all the
Jordan.
way
I
up.
love it.
Yeah, I mean, I didn't take it all the way up to not see it all the way through down. Now, to take that question though, I will say that it has to be particular advice to the mortgage and what your goals are. It really does depend. It depends on, is your goal cash flow? Is your goal, like, it really depends where your mortgage is at. Another thing that goes into that, actually, to answer that question, is there's two different types of variable term mortgages that I don't think everyone knows about. There is your static payment. So meaning that as the variable interest rate changes, fluctuates up and down, your payment remained the same and it just changed what went towards principal versus interest. There's also the other one, the second one, which is adjustable, meaning your payments actually fluctuated along with the interest rate. So depending on the mortgage scenario that this client might be in, my advice actually might be different, because you locking into a fixed term, if you were in a static payment and actually saw interest rates go up and you lock into a fixed, your payment actually could be higher, even though interest rates are lower, because they may make you catch up to all the principal that you didn't pay. So anyway, not to confuse things, I just mean to say that every mortgage is different. I don't have a general answer, but I will say for myself, and the advice I give Carol is to stay within the variable for right now. I do think that there's room for further decreases. And if things were to go into the opposite direction, I guarantee you, we will know. It's going to be all over the news. It will break headlines. We will know. And we don't see it right now. We don't see that happening right now.
So I love this question. Best options for someone who can't shop around and must stay with the same bank. We talked just briefly about reasons why somebody might stay with the same bank. So if you don't qualify, so your employment situation has changed and you're worried about requalifying again and you just want to sign a renewal, give us some language, Jordan. And you've had the unique experience of working both on the lender side and also on the bank side and on the broker side. So I have a mortgage. It's coming up for renewal. I have no desire to shop it around, change my mortgage terms. I'm just trying to get the best rate possible. And let's say I'm a fairly inexperienced negotiator. Somebody calls me or they send me a letter and then they call me. Give me some simple language that I can throw back at them just to try and get the best possible deal out of them without actually shopping the mortgage around, if that's what I choose to do.
Yeah, no, for sure. And that would go back to what I mentioned around, you really want to, I hate that you have to do this, but you really want to kind of not threaten, but leverage your conversations with another professional. And even if it didn't happen, to be honest, that is what you want to let them know. You want them to know that your business is this close to leaving if they cannot provide you the terms that you're looking for. So you want to just say, listen, I have already, you don't want to say I'm going to, because then they know that there's room for them to, not give you the best interest rate. But if you are already engaged with another broker or banker and you let them know that because you're halfway out the door, tell them that. Say, I'm already engaged with a broker. I just need to know your best and final offer before I make my decision to move on and proceed. So whether you have already had that conversation or not, that's what's going to get them to really actually give you their bottom and best rate, because they really are going to believe that if they don't give you the best, that you're pretty much going to walk away. So that's what I would say. Always leverage your other relationship.
So if nothing else, best language would be, is that your best offer? If nothing else, if that's all you're going to say, ask that question. If absolutely nothing else, because more often than not, the answer will be like, well, actually, we might be able to do something else for you. So I think that's really important. There's a question here from Walter and Roxy. Can you talk about the impact of the rate increase will have on your payments? We have one of those 1% to 2% fixed mortgages and are a bit worried about how much pain is coming. So when the renewal hits in the next couple of years, and they're now moving out of a fixed rate mortgage that was somewhere between 1% and 2%, and they're now going to be going into a mortgage that is, I guess, in the 4s probably. What does that look like? How do you mitigate the impact of what that change will be?
So in terms of mitigating that, what we can look at is, of course, you want to take on the lowest interest rate. That's the first obvious thing. But the main thing that's going to alleviate cash flow issues is looking at extending your amortization. If you remember what we mentioned at the beginning of this, is amortization is what dictates your monthly payment, because it's the length of time that it takes to pay off your total mortgage. So if we can look at extending your amortization period, that would lower your mortgage payment to put you back into a comfortable cash flow position. Now, I understand that extending amortization is something that could be difficult mentally for a lot of people to do. You know, they paid down their mortgage significantly. They don't want to extend it back out. But I do say that you have to look at the payment. You want to be comfortable in the payment. And if amortization is what gets you there, that is a tool that we have to use. You will always have some kind of prepayment flexibility with every lender, with every bank, that varies between 10 to 20% that you will be able to prepay your mortgage. So although we are extending your amortization for the sake of your payment, you have full flexibility to be able to prepay your mortgage, put it towards your principal, and bring down your amortization, but within your own control and when you have that additional savings too, as opposed to being forced to make those higher payments.
And so I would just say, Walter and Roxy, who asked the question, and for anybody else who's thinking the same thing, just understand time is your friend. You can start to engage if you've got a mortgage coming up in the next 6 months, start to think about all of these things, because you'll want time to be able to avail yourself of shopping the market. But also, if you are going to switch lenders and it requires a requalification process, or at least resubmitting your documents, you want to have the opportunity. Like, it take time to collect up all your documents. You need your notice of assessment, you need your bank letter, you need your employment letter, all of those things. Give yourself enough window so that you're not up against a wall to sign a renewal in a short period of time. So that you have enough. And so, Jordan, I think we'll probably leave it there, because we are at the 1.5 hour mark, if you can believe it. We have talked a lot.
We love to talk.
And I'm grateful, Jordan, because clearly you have just a wealth of knowledge. And one of the reasons why I asked Jordan, to be on this call tonight is because, one of the reasons why we refer you as one of our preferred lender partners is because we've always taken the perspective with our clients of just providing the best advice possible. There has been many times when I've referred a client to you that is up for a mortgage renewal, and you've come back and said to me, Carol, they have a great offer in front of them, and we've shopped it and there's nothing better. They should just take that. And so I appreciate your no pressure approach. It reflects the same commitment to customer service first approach that we have at the Carol Claudic Real Estate Group. So I'm grateful for the way that you approach your business, Jordan. And I know that you do your clients a great service, which is why I've asked you to be here tonight. So we'll send all of these slides and the recording to you with a follow-up. So for attending, we've got your email address. We'll pass it along. And of course, you can set up a time to meet directly with Jordan if you like. And a reminder, guys, that Jordan is bound by confidentiality. So if you share information with Jordan, she does not share it with us or with your real estate professional. The information you share with her is confidential. So even if you find yourself in a situation which is, perhaps not favorable, perhaps you're not in the financial situation you were when you got into your mortgage, you're stressed out about it. Sleepless nights are not necessary, guys. If you're worried about it, justifiably or not, I want you to make an appointment to sit with somebody who is knowledgeable, that can walk you through what's going on in the mortgage market right now and calm some of your fears and anxieties, or answer your questions, because we have these resources to share, and we're always happy to. So I want to thank you, Jordan, for sharing tonight, and to my sales team for sitting in on this call. Again, guys, you'll get a follow-up from one of them in the next couple of days. It's always an honor to be of service to you guys. Thank you for hanging out with us tonight on this snowy evening. I'm at the office. And the curtains are down, so I don't know what it's like outside. But hopefully this has been a great way to spend a Wednesday evening learning and sharing knowledge with us. So stay tuned. There'll be an announcement in the next couple of weeks about our next seminar, as equally important to both renters and homeowners as well. It's about home insurance and renters insurance. So stay tuned for that. But thank you guys tonight, and from the Carol Claudic Real Estate Group, have a wonderful evening. We'll catch up with you guys again soon. Good night.
Thank you.